Welcome to another conversation on Business Redefined. We want to look at Capital Markets Outlook 2022, and we are privileged to have the man in charge of the exchange, Mr. Geoffery Odundo. As always, delighted to have you on set.
Pleasure, Julian.
Jeff, let's begin by having a slight recap of 2021. I was looking at the year vis-a-vis 2020. If you look at the benchmark indices, looking a little good, especially the NSE All Share 25, 20 not quite. But looking at it from an equity turnover standpoint, it looks almost like a flat line.
Yeah.
Does that bother you, Jeff?
Well, we were very optimistic last year about how the markets would perform, and we actually did expect to see almost a 10% growth in our equity turnover. But I think the early part of the year, the knock-on effects of the COVID-19 impact continued to affect the markets. So we sort of slowed down after the first quarter. The second quarter was a bit of a very slow quarter, and so we lost a bit of momentum there. And so that has sort of led to why we are seeing sort of a slower turnover growth. I think we are just 7.5% behind last year on the equity side. So I would basically attribute it to the market just maintaining its sort of an equilibrium, nothing really much to excite the year. We had hoped to bring in some stimulating IPOs that didn't work out, and we thought those were going to help. But I think market was just holding, and investors were sort of just rebalancing their portfolios, playing a bit more into the fixed income side as opposed to equity. And what also contributed to that is that the yields on the fixed income were very attractive throughout the year. So there was really no opportunity for the equity market to benefit from a reallocation of capital.
All right. Speaking about a intention to have some stimulating IPOs coming over, and which didn't materialize. When you look at 2022, we've already received some indication from players like Centum Re. Never mind, they're indicating they might be looking elsewhere. What sort of pipeline might you be looking at? And are there domestic inhibiting factors which players are telling you, if you address 1, 2, 3, we might consider coming on?
We have a pipeline that we've been working on for the past 3 years, trying to really get issuers to come to the market. Our primary focus for a long time was on government, because we know there are quite some good companies in there that can actually be able to come to the market and really provide a reasonable quantum of shares to help the market really stimulate up. And so we put a lot of focus on that. We've also been talking a lot to the private sector, but that's been a bit of a difficult conversation because there are a lot of competing options that they are exploring. If you think about the banks, the private equity players, even the donor agencies are really participating in funding corporates. So those have been our key concerns. But looking in 2022, we have a pipeline. We are very, very convinced that we should be able to actualize two listings by the first half of this year. We've been working on that. And these are companies that have actually got clear objectives to do things in 2022 despite the elections. These are plans they had in place. They basically want to actualize them. The transactions are actually very, very warm, so they need the capital. And so this first quarter should see maybe one company make a move towards coming to the market to raise money. So we're optimistic about that. We're also hopeful that the government will finally consider doing something, possibly, if not a listing, but a further sell down of an existing issuance, largely because the Privatization Commission appointments are progressing. And we hope that once appointed, then there could be efforts towards seeking capital through the capital markets through a sell down or maybe one issuance. So we're going to be focusing a lot on that. So I think with that, then the journey will begin. And possibly as we go after the elections, when everything starts to settle down, then a lot of players will come.
Staying with the issue of issuances, one of the challenges that I have as a market watcher is that the issuances we're seeing coming on board are not reflective of the environment, if I could say. Let me give you an example. If you look at global equities right now, we have the tech stocks really coming strongly. players in the pharmaceuticals, the Modernas, etc., playing very strongly. But when you look at our listings, it looks like we are almost frozen in time. When you talk about a pipeline, are you seeing now a composition which you would say is reflecting the e-commerce penetration, the pharmaceutical space?
Well, how we've been able to position the exchange is we are a very open capital raising platform, a very clear venue for raising capital of any nature, and we have got products that are very targeted towards specific sectors, and so we are engaging, especially with these new emerging sectors. The tech space is a big area for us. We are working on seeing how we can have further incentive improvements to allow tech companies to come to the market. They're very unique in nature. They have very light balance sheets. They're more intellectually led organizations. The assets actually intellectual property, and all this you need to configure out how to have them valued and derive some valuation so that investors can actually be able to appreciate their value. So we are working on incentive structures, especially around tech companies, and really think about even coming up with a thematic board that's so unique to tech space and have that in place. So that's a plan we have. And other sectors have also got targeted products, for instance, real estate, etc. So on these new emerging sectors, we have companies that we're engaging with and who are asking us how can we help them raise capital. I would not be able to say there's anything very, very significant at the moment in the pipeline, but I think with time, and especially this year as we put and lay more focus and really bring through some of these incentives, we should be able to attract a couple of them to come through. A lot of them, first of all, intend to want to come through the private market, and we've got this unquoted securities platform, which is basically like an OTC for the NSE, and that's where we think we'll position them first, sort of have them there to prepare and strengthen themselves, still raise capital, and get liquidity events when they want, and eventually migrate them to the main market. So we'll probably start there for now and see how that progresses.
All right. Another question, Jeff, is that one of the hallmarks of 2021 was that day trading finally went live. 1 month down the line, when you look at uptake, how is the response like? How is it contributing to your turnover at this point? And more importantly, one of the ideas behind day trading was to tap into a demographic which we felt was being left out in this market. Are you seeing that demographic being brought on board?
Yes, so we launched day trading last year in November, and within a month, we saw a 7% increase in turnover. The value of that period was about 784 million in actually day buy and sell trades. So that's the kind of turnover we saw. Very, very good start. And I think the players have been waiting for this for a while, and everything we did around making it happen has really excited the market. We as you rightly put it, we are targeting a certain demographic, especially the youth, who love momentum, who love high levels of volatility, who can appreciate volatility. I think where we still have a bit of a handicap is the trading front ends that our brokers are using. I think they need a lot of them need to develop apps that can allow onboarding, quick account opening, very, very user friendly, just like we see around what happens on the forex trading side. That level of efficiency is desirous, and I think some of our trading members are thinking of changing their front ends to allow that to happen, and that should be able to see more and more activity happen. The other issue is I know a lot of them have come back with feedback to us about the pricing, especially as we discussed on the second leg. We have already provided a discount as the exchange, and we're also trying to convince our other partners who benefit from levies to consider also providing some incentive to make it more efficient. I think what we're looking for is turnover. And so whatever price, it has to be very, very cost effective to encourage that to happen. So I must say it's a very, very good start. What we intend to do this year is really provide a lot more education, a lot more visibility on what it's all about, a lot more engagement, trainings, etc., just to really make it pick up. But I think we're off to a very good start.
Okay. Speaking about the discount on the second leg of the transaction, Jeff, I looked at the amount that NSE is offering, and I was like, really, is this the best that NSE can give? And one of the thoughts that crossed my mind was NSE might be really struggling in terms of preserving its revenues because you give the discount, you're foregoing something. Was that a really challenging decision for you guys to take?
So, with day trading, cost is everything because the spreads are small. And so we were very conscious that we needed to come up with a certain level of discount as a move to make this happen. And so we reduced our fees from the 0.12 to 0.114%. And our intention was to trigger our core partners to also follow suit and eventually try to make it more and more cost effectively. Now, we are looking at it because we're getting feedback. We've got feedback, for instance, that is it possible for us to just charge on an aggregated basis as opposed to individual trades to make that cheaper? There are very, very other feedbacks about how can we make it extremely very, very cheap. But again, we have a commercial interest in the product. So we put a lot of investment behind it. We have put money in it. So we have to ensure that there's a return that's also commensurate to us. So it's something that we understand. It's something we hear. And we are doing our own assessments. And I think we'll engage more. And once the data starts coming out like it's coming out now, we'll be able to, I believe our partners will be able to consider further reductions as well.
You're quite spot on in saying that in day trading cost is everything, and I'm putting myself in a broker's shoes. One of the challenges that I'd imagine they're confronting is that do the volumes they witness compensate for the possibility of giving more attractive costs on their side? Because we know a number of brokers are struggling, and that's one of the issues they actually raised with me when this was rolled out. So how do you see it playing out for them on their side? Because they are really grappling with this issue of the cost side.
That's a very good question, Julian. We've actually asked the brokers, why can they also consider discounting their fees? Because they haven't. And I think that's also contributing immensely to that. But we appreciate that it's been challenging times, especially for broking houses. The last 2 years have been extremely difficult, and so we didn't want to make a strong case for them to bring their fees down immediately. But I think what's going to happen is that competition will drive price down. I can imagine a broking house that'll have very high levels of efficiency will actually be able to bring their price down faster than another brokerage house that probably has a heavy cost base at the back end. And so I think that's going to be, the competitive nature is actually going to help the price come down. So that for me is going to be a natural event, and I'm not too worried about it. But I think what this means is that a lot of our broking houses must try and see how they can make their businesses more efficient, how they can also make their access points more available, provide research to especially very readily available research to investors so that they're able to make those decisions quickly. So that's sort of what we expect to see going forward. Our role was to provide ability, which we have. And so I think the other thing just rests on the broking houses and how they can be able to make this more efficient from their end.
Okay. Jeff, I'm really curious. What's the interplay between securities lending and borrowing and day trading? And why I'm asking that question is because day trading by its nature would necessitate very liquid markets because of the high momentum that you need for entry and exit. And here we rolled out SLB to be able to unlock some of these shares which are held for long term and really in blocks. So are you witnessing any interplay that this is facilitating day trading?
Well, not for now. because SLB framework is just taking off now. We have just had the approved agents in place. All the approvals have now been granted. They're out of the sandbox, and all this has been tested. But it hasn't yet happened. What you're seeing right now are basically cover day tradings, where people are basically selling what they've already have, and not naked. What will happen in the long run is that there's going to be ability to actually short in the market, where you just go and take a position in the market, but with the intention to cover that using borrowed securities. And that's where we're going to see that framework really trigger off. And we think there's going to be great flow coming through. One, why? Because a lot of the people who have invested in this market have taken long positions. So they've got these shares which they don't sell at all, and which they earn nothing over. And the minute they're able to see that there's actually revenue to be made out of lending stock, then you're going to see this other side really, really trigger up. Because I'll be able to go to the market, sell what I don't have, come and borrow for settlement. Buy what I don't have and also borrow for settlement. So you're going to see that activity pick up quite well once this framework works. And I'm happy that at least the day trading is now active and it's building up. So the next thing will be, how can we go to the market, exit a position and come and borrow? And so we expect to see that happen a lot.
Okay. In 2021, we also witnessed the partnership between Safaricom and the NSE, Bonga points for shares. How is that going?
So this was part of our digital transformation strategy, and a lot of that is still ongoing. I'm just glad to say that we turned around that in 1 month, very uniquely, to get from conceptualization to launch was only 30 days. And working with Safaricom was a very, very great experience. So far, we've seen conversions equivalent to 1.25 million shillings. So not what we expected. I mean, Safaricom are sitting on a huge amount of this Bonga points in their balance sheet, and they want to find a way of having those converted. So it's been still very slow, I must say. And they told us, don't be surprised. It's like Kenyans keep Bonga points as assets. So it'll take a lot of hammering, a lot of marketing to really convince them to convert them. And he challenged us. I mean, told us, how many Bonga points do you have? And actually, when you look at your phone, you actually have Bonga points. So a lot of education, a lot of marketing around that, again, is what we're going to focus on in 2022 to make sure that people can actually take advantage of those opportunities. I can tell you, if, for instance, we got a big IPO today, a lot of those Bonga points will be converted because people will now need cash to invest, especially if it's a stimulating IPO, a very exciting, a very big one. And I think those are the kind of things that we hope to really help this opportunity work. And so, yeah, so you should see a lot of campaign around it.
But maybe the counter narrative to what you're saying, Jeff, is that is the abysmal uptake an indication of something around your product innovation? Because Kenyans think of Bonga points more as safety nets. So if you have a house help or a guard who needs a phone and you just don't want to go to your liquid cash, then you wire it that way. Does it speak to the manner in which the NSE goes through its product development?
Well, all our innovations are informed by market needs. We do a lot of research. We carry out a lot of market study. We speak to partners who want us to do things for them. And these are all informed by that. There's no product we bring to the market that doesn't have a basis. We have a strong business case behind it, including projections on how we want to convert. And that's what's applied to all our products. So even for this Bonga point thing, we are very confident that with the right campaign behind it, with the right need for or the right assets coming through the market, we'll see faster conversions, and that's what we hope to do. I must tell, with every product, there's what you call a gestation period. You cannot just launch a product and then expect it to blow up or kick up, overnight. It takes time build. I recall when M-Pesa came to the market. I mean, a lot of us bought an M-Pesa after 3 years. I mean, today it's now the big thing. So I think we give ourselves a lead time of maybe say 3 years to see how the market operates, and we consistently evaluate our products. So we have something we call our product development committee that looks at all products and says, is this meeting our targets? Do we need to tweak it, or do we need to suspend it or something like that, just to inform some of these decisions. One thing I must say is that you can't stop ideas whose time have come, especially innovations. This market would remain very, very thin, very local, not internationally flavored. Now we've got a derivatives market, we've got SL, security lending and borrowing, day trading. So international investors come here and they're doing the assessments. They say, do you take this, do you take this, do you take this? And that even promotes our existing products. They say, then I like this market because you actually are looking forward.
The top leadership of the exchange made a trip to the JSE, the Johannesburg Stock Exchange. And we have seen a lot of increasing bilateral ties and engagements between Kenya and South Africa, including the much touted potential consolidation between KQ and SAA. Are we expecting any partnership at the exchange level between NSE and the JSE?
So the NSE and the JSE have been working partners for many years. When we were setting up some of our new markets, like the derivatives market, all the technical support came from the JSE. When we were doing looking for our technology to run our markets, again, we worked with the JSE and we're using the same systems again. So JSE has always been our partner in Africa because we believe that as a leading market in Africa, they have the benefit of really being able to really understand the intricacies of good markets and very good standards. So they are a natural partner. So we have an MOU, which we signed many years ago. I think it was around 2012, 2013 there, which informed a lot of these relationships that we've been having over the years. And so we went back on the sidelines of the meeting to try and re-energize this MOU, find new ways of working, look for new opportunities of working together. And they were very excited. In fact, we met the full top leadership there. And some of the things that we're looking at are cross-listings. They feel that their market is too mature now, and they think arbitrage might be the way to help investors in their markets also benefit. So you'll see companies that are listed there, also cross-listed here. Just look for any arbitrage opportunities, and we hope to see that as a key thing. They've got a new focus on SMEs. We have got a focus on SMEs through Ibuka. Again, opportunities for collaboration and working together. Our derivatives market is very, very new. They are the only other derivatives market in Africa. Again, we are learning how they were able to build and ramp up their numbers. And South Africa has got a huge amount of capital that's looking for a home to invest. In fact, they were just saying there's so much money in this country. So we have to tap into that capital. And so we think those are the kind of relationships that we'll have. So we're strengthening. It's not new. We are strengthening our relationship. We believe that it's going to play a very big role, even in terms of helping the bigger agreements that were put in place. So for us, it's a very good business relationship that we're building together.
Right. Let's now talk fixed income, which was really the sweet spot, in my view, last year. We saw a couple of really investment-grade issuances, much to our delight. When I look into 2022, I'm a little worried because I've seen the yield curve going up, the sovereign yield curve for that matter. And I'm wondering, for the corporates who are now coming in, won't pricing be a problem for them?
Just to reflect back to 2021, Julian, you're right. It was a great year. 3 issuances, all successful, with the last one extremely successful. And for us, why that was a good event is that it sort of puts us at a point of recovery. Don't forget that this market had gone through a very serious challenge with some 2 issuances. And so this just speaks to the fact that the market is deep enough, people are looking for credible assets, and they're willing to support. And when you looked at the last one, the EABL, a lot of investors in that EABL were institutional funds, were the banking sector, and retail. There was a huge amount of retail. And we've always been putting a case that we need a lot of retail to participate in the market to really enhance also the secondary market trading. And we hope that the EABL bond will be traded, because I think that's also going to be a good sign that the markets can be used efficiently, especially on the secondary side. Now, having said that, you're right. The yields curve have sort of moved up, and so probably the pricing will be a bit expensive than last year. But I think in the overall scheme of things, if you price in the fact that a lot of issuances, especially if they're credible, they can actually get this money unsecured. And so compared to getting a bank financing, this still remains a cheaper source of funding. And we expect to see that happen. A lot of them, again, price off the sovereign, slightly above the sovereign. And if it's a very credible issuer, it gets very close to sovereign. And I think we hope to see those kind of players coming in. What again I want to say is that the corporate debt market helps companies also begin the journey towards complying with listing requirements. You see, because once you do a corporate issuance, you're expected to meet certain obligations. And that helps you already begin being a very transparent company, helping you comply with listing requirements. You start feeling the effects of regulation. And eventually this should help you also find it easier to convert into a full listing. And so we think that's a market that we like so much, and we believe this is where we're going to focus more. We hope to see a lot of institutions raise money through this market, both in government and public, in public and private, and help this market grow faster.
Okay. Jeff, speaking about the necessity of catalyzing retail participation in fixed income, any thoughts around EMA-KIBA? And why I'm asking that is because for a number of stakeholders I've spoken to, their take-home is one: EMA-KIBA was a brilliant product, not properly structured. And the argument has been perhaps we should have structured it as a collective investment scheme as opposed to reaching out to the various retail investors individually. Any thoughts on that, Jeff?
Yes, EMA-KIBA was a very innovative idea. We still think it's exciting. People are asking us when is the next issuance. The government is looking at how to revise the structure. We are not part of the conversations as yet. I think they're looking at other options. But that technology and structure is something that we're not going to let go. We believe we can be able to also use the same technology to do corporate bonds, for instance. And as to your point about having debt assets come through our collective investment schemes is really the way to go. We are fully supportive of that. And so we want to work with issuers to see how that can happen, to have more, for instance, corporate debt paper come through a CIS structure, which then is supported by an EMA-KIBA platform for onboarding and settlement. And then that's the kind of thing we're looking at. So we're going to be looking at that. It's a way to go. I must tell you that the lessons we learned from EMA-KIBA were very, very good. This is one market that we saw very easily onboarding, very easy secondary market trading, very easy payment of interest and coupons, and finally, maturities. We did not get any glitch or any failures in all those aspects. So this just tells you it was a successful product. The problem was lack of full-blown marketing and education, which was a big issue. Probably the structure was not very, very attractive to investors. But I think it's something that we can improve on to help get the retail back to the market.
Okay. Jeff, something I'd like to spend some time on. I am aware of the plan to set up a structure which essentially, you could correct me if I'm wrong, takes fixed income activity away from the Nairobi Securities Exchange, and that is via the EABX platform, which you and I know is already recruiting a chief executive officer. What does this mean for the exchange? I shudder at the thought of NSE with only equities and not fixed income.
Yeah. So our recollection of the intentions of setting up another exchange, where I think was mooted some years back by a study done by one of the donor partners about a hybrid market in Kenya, saying that the Kenyan market could actually grow faster if it was a hybrid market, meaning that it had an exchange-traded debt market and an over-the-counter traded debt market. So that was the plan. We were initially involved in those conversations just to understand what the plan was, and maybe are there any areas that we could also contribute positively towards. The conversation then has been going on quietly, and now we're seeing an OTC bond exchange is being established. Now, we think that we've got a very good debt market in Kenya. We've built a very good market over the years. Today, we have got we could be the second highest, the second exchange in Africa with the highest turnover of sovereign debt paper. The largest exchange is JSE because they trade a lot of corporate debt. But when it comes to sovereign or government securities, we could be second in Africa. Now, with that, what have we done to just help our fixed income side market grow? One, we have fully automated this market. All securities are dematerialized, meaning that everything is being held in electronic form with the central bank. We have reduced the trading cycle from 3 days to a day. And in a day, we're doing almost 3 cycles of trades. You can buy and sell 3 times on the same day. Ease of settlement. We have worked with our partners, Refinitiv, to provide a platform for negotiating and agreeing on transactions through a call platform, which makes it very easy for trades to be confirmed securely through channels like that. Everything is happening extremely well, and hence we have a very good secondary market. And that just explains why even last year our turnovers went up 38% from 691 to 956 billion shillings. And we've helped the government raise money easily because of the ability to provide good exits. So we've done everything right. So we at the exchange did not see the need for a second exchange. I think we could just build on this, see how we can provide avenue for other players to come in. We have got a license that allows other players like banks to come in directly and connect and trade. And so in our view, having a second exchange, there was no merit initially. And the other argument we put across is that you'll have disparities in pricing. I mean, you've got 2 securities that might trade at different yields here. How do you merge those yields and come up with a standard platform? The NSE yield is what is used for pricing assets. Yeah. And hence, we thought that there's need for us to maintain our repository role as a trade repository for purposes of that. But having said that, probably we think there were maybe overriding considerations and feeling that we should actually get a second exchange on board. So we know that there's going to be competition, but we have to maintain our leadership and maintain our focus in getting our market to remain where it is as now. So we welcome competition. The challenge is that we don't know. We still believe that there should be complementary roles that we have to work together. We've seen this model in Nigeria between the FMDQ and the Nigerian Stock Exchange, and we wait to see how that will evolve. But I can tell you from the very outset, as an NSE, we didn't see the merit in having a second exchange in a market that is still this young, and then create this two scenarios that might present other problems. We don't know.
Suppose the fixed income is actually hived off from the exchange. What would this mean for you from a revenue standpoint?
So right now, the fixed income contributes about 7% of our total revenue. It is significant for us because we have every plan. We have every plan to grow that revenue stream to take it to over 10% or close to 15% of total revenue. So we take it as a very important asset class for the exchange. But the reason why we even diversified our product offerings is because we wanted to de-risk our business from a concentration of two asset classes. So we've got equities and fixed income for many years. So the reason we have derivatives, ETFs, and all these other products is to then try and concentrate our revenue streams and have more other products contributing. So in the long run, if all our other products pick up, then I think we don't have a real risk because we have other revenue streams that can help support our business. But that possibly will take time. But in the medium term, then we need to be very, very aware that we need to work hard to retain our market share because we'll sort of lose a bit of it to the market and find out we're just keeping our market share through this. The other focus for us is to go regional and to really bring in regional companies to come in on existing products and new products and more collaborations across the continent to also diversify our income stream. So we are now out of our what do you call it, comfort zone, and really we've been shaken out to go and do more to protect our business.
What would you say to the view that the necessity of this move is the fact that the NSE, from a turnover standpoint, has become so fixed income centric? There is need to carve it out and create ample space for dedicated focus on equities and how to grow this space.
I would not say that we are fixed income centric. I think we're just going through a normal market cycle where our fixed income markets are doing very, very well compared to our equity markets. Our primary objective is to help our equity market grow. That's really our bread and butter, and so we put all our energies there to achieve that. So I don't think the objective was to help NSE get out of any comfort per se. I think it's informed by the fact that I think when they look at other markets like South Africa, they find that the debt market is very big, and possibly the argument then was that just leaving it as an exchange alone, and the structure that we have where all trades are traded through broking houses and all this, that there was need for a separate market that trades differently. Maybe that will trigger the market to turn over better. So those are really the overlying objectives. I think the argument then was they feel that the investors need to trade directly more together. That's why they're creating a bilateral trading platform. They thought cost of trading is higher because you're going through brokers. They were saying that the market is not so visible from a depth perspective. I think those are the arguments. But we have solutions to all those concerns. But they still made the decision to move forward. So we'll take it on.
Jeff, I'm seeing our time is fast spent. Let's wrap up this conversation. Looking into 2022, just give us your general outlook. Many guys are looking and wondering, we have the twin risks of COVID-19 still with us. We have an election cycle coming up. What's your outlook for the market?
So we've taken a sort of a fairly, I would say, a muted optimism on this year. Why I say muted is that it's an election year. You could have all these strong plans, but how the elections play out is different. Kenyan's elections are very interesting events and can actually run a long time. We are hopeful that this time the frameworks and everything will be much better so that we can get the elections done with. I'm happy it's a media event, not an NDA event. Otherwise, would be on campaigns from January to December. I'm happy it's a media event. And so we are holding a fair optimism on the market. We are focusing on getting our objectives achieved, be they the listings, be they turnovers, be they new products uptakes. You'll see that same momentum, that same pressure to achieve that, because for us it's business as usual. We believe that political risk is going to be priced in very well. Investors understand this when they do their investment decisions, and so we're not very worried about volatility in a big way. People normally think we'll see big swings. I must tell investors, buy now. If you're waiting for further discount, I'm sorry. Investors they price this 1 year in advance, so you might not see very high volatility. So this is a good time to buy. And so, and I think Kenyans are becoming very aware about other opportunities of creating wealth. And I think capital markets will provide that. I'm really excited about the diaspora. They're keen on getting back to invest in their home country. That's going to be a big focus area for us, how to get diaspora in through platforms that are helpful and more marketing out there. We're focusing a lot on our alternative platform, the unquoted securities platform. You'll see a number of issuance come there as well to raise money. And so for us, it's a positive year. We are looking strong. But again, we're very conscious that the twin risks that you talk about are real. So we also have to manage our cost structures. And so a lot of that has to be in place. But yeah, we've seen many elections, and we hope it will go well too.
Final question, Jeff. Now that you've mentioned the diaspora, looking at the strength and resilience of the remittances, even in a very risky environment like COVID-19, sometimes I wonder to myself, could Kenya be getting late or missing the boat of a diaspora bond?
Yes, that's a good question, because it's been a long time coming. I think it's something that we should go ahead with. There's a huge interest in that, especially looking at the remittances. Kenyans would like to have an asset class out there that's unique to them. And the experience is good, especially the fact that we've done enough Eurobonds. So if you're looking at how to manage the currency risk, I think that's now something that the issuer, the government is familiar with. And I think they need to start thinking about putting in place a diaspora bond in place. We as the NSE are willing to partner and help them structure it and find a way of even having it listed to create ability to have liquidity. Because we have a huge diaspora out there, they're looking for assets. We've been trying to educate the public that I think Kenyans need to change their investment philosophy from brick and mortar and get into assets like this in the capital markets that provide you with more safety, especially if you're out there, and more liquidity, yeah? Especially if you're out there. Yeah. So something like a diaspora bond is something we are really, we'll be very happy if it can happen very shortly.
Right, unfortunately, that takes us to the close of our conversation with Geoffrey Odundo, focusing on Capital Markets Outlook 2022. We shall continue highlighting emerging issues as far as corporate actions are concerned.